Ring. What's up, baby? No, he hasn't called yet. Hello? No, I'm not interested. I'm tired. That feeling you get when you're just waiting for your loan officer to call you back and tell you what income they use, how much do you qualify for? It's like that pain that just sinks into your stomach. Like, what? I make way more than that. There's no way. But guess what? The truth hurts. Today's video, income. What is the actual income they're gonna use to qualify you? That is the riddle every consumer and client mind wants to know. So there's 4 types of income. There's fixed income, which is your alimony, child support, social security, and permanent disability. Don't forget, disability has to be permanent for you to be able to use it. Second one, rental income. So your rental income is not what you collect in rental, it's after all your deduction, your mortgage payment, your tax, your insurance, any upkeep of the property. After you subtract all that out, if it's still positive, you get a positive income. A lot of times they claim that they receive so much in rentals, they miss all the deductions. Well, after the deductions, you can be negative, which can help deplete your income even more when you try to show income to qualify for another loan. Normally that happens pretty often when it comes to people who have multiple properties. So no one wants to pay Uncle Sam, so they claim as many deductions as they can. Everyone's trying to hide from Uncle Sam, right? And the next one, the most important one, is self-employed income. The third one, where you at? Where you at? Where you at? That's how I feel when I'm self-employed. People, when you do self-employed income, which is your sole proprietary, your S Corps, your C Corps, and your limited liability. Because we're too busy trying to dodge Uncle Sam, guess what? We're dodging the loan officer as well because we don't qualify. A lot of times, it's not what you take in. Remember that. It's after your deductions. After your deductions, you might not have any income. A lot of people call and go, hey man, I make $100,000 a year. But after I see their deductions on their self-employed, they really make $25,000 a year. So be careful. When you're gonna buy a home, start preparing yourself. If you're self-employed, guess what? Pay Uncle Sam. Show more income. The more income you show, the more you can qualify for. After you're done closing the loan, you know what? Deal with your taxes later. You know, the following year, then claim more deductions. But if you're gonna buy a house, pay your taxes. And our last one, the numero uno, the most importante, the number one used income is wage earner. What? Your wage earner income. So don't forget, there's also different types of wage earner income. There is your 40 hours a week salary. There is commission W-2, and there's also bonus. Bonus a lot of times trickles into hourly and commission. When they take your income, they break it down to see what you qualify for. Remember, I had a client, all of a sudden he had a Disneyland pass. So every Friday he went to Disneyland. Guess what happened? It drove down his income. When it drove down his income as a wage earner, he couldn't even use his salary or his hourly to qualify because he was so inconsistent with his hourly income because he went to Disneyland so much. So remember guys, if you're gonna use wage earner income, be consistent. Whatever consistency you have that's the income they're going to use. So if you're using bonus and overtime to qualify, I would ask my loan officer that, bro, are you using overtime and bonus to qualify? If they say yes, make sure you're continually getting bonus and overtime so you can qualify. So those are the 4 different types of income. If you have more questions on income or how to calculate the income, check out my next video. Thank you guys so much. This is What's a Mortgage with Min. And don't forget to share this video and like my fan page.